The e commerce industry, otherwise known as the internet retail industry, has been doing really well for 10 years and it has a very bright future. I wanted to go over the best and the worst stocks in this particular industry. There are some gems, there are some obviously very valuable businesses, but it's not enough to identify a really good business. What I also have to have is a really compelling discount. I invest in stocks to buy low, hold, and then sell high. My holding period would be very long on a very strategic stock. So I'm going to be covering some stocks you probably have heard of, and I'm probably going to cover some stocks you never heard of. I'm going to go international. I'm going to cover the obvious big stocks in the US, as well as some stocks in Asia, Europe, and Latin America. In general, just to cover the five biggest market caps that I'll be covering in this video, Amazon is only up 8% if we look at the year to date, but some of its peers in the e commerce space, like Alibaba, up 72% year to date, Mercado Libre up 39%, Sea Limited 81%, and Prosus, which is in Europe, up 38%. So this space has been a hotbed. If we go to the 1 year, it gets even better. We've got Sea Limited up 150%. Incredible. Prosus up 64.87%. Amazon up 36%. Alibaba up almost 80%. So this space has got a big part of the future. We're not going to slow down our spending online. It's probably just going to increase now that we have physical AI with things being delivered to us by robots, things showing up to our curbside, or even a robot bringing it all the way to our doorstep potentially in the future. You have Amazon working on drones that will be flying over our homes and dropping things in the backyard. So it's a really neat space, but in general, the core business model, it is here to stay and it's just going to keep growing and growing. So let's get into it. I'm going to go from biggest to smallest. And how will I determine if it's the best or the worst? The lens that I'm going to use is valuing each company, comparing the intrinsic value that I calculate based on the future free cash flows I expect from that company, determining the intrinsic value, comparing it to the stock price to see if there's a discount or if that stock's being priced at a premium. Remember, it's not good enough to find a good business. You can find a good business and pay too much, and then that business will come down to its intrinsic value over time. But if we find a great business at a great discount, now we're talking. That's what I'm after. The worst business would be potentially a business that doesn't have a bright future and is priced too high. Now, that would be the worst of both worlds. So I'll point that out. So let's get started. Amazon is a $2.5 trillion market cap company with revenues of $670 billion. It is the biggest revenue company in the US now. They took over the number one spot from Walmart. They have very good net income, and their PE ratio is a little high at 36 with a forward P of 34. Strong buy according to analysts, and it's discounted about 10%. The stock is not keeping up with its peers. If you compare it to Nvidia, nowhere near that return, and others like Meta and even Google now, this stock is lagging those peers. The financials look good and the revenue is growing very well, but the company has made decisions to pretty much sacrifice short-term results in profit and free cash flow by investing in the business, making the business stronger on the e-commerce side, and investing a lot more capital on the cloud side to build out their cloud for the AI push. I agree with both. And I know that it's a little bit of discipline. It's a little bit of, we're going to need to wait for the company to grow in the future and get the return on investment in the future. But that has been Amazon's culture. They will always sacrifice short-term benefits for having a long-term strategy that is the best thing for their business, for their customers, and for their partners. I've completed a valuation for Amazon. First, looking at their free cash flow forecast and forecasting what I think they're going to do with cash flow. As mentioned, they've taken a short-term investment in their cloud operations, really put a lot of capital there to work. But I think we're going to get back on track of really delivering high free cash flows down the road. When I built this cash forecast, it really does represent what I think is going to happen from a business perspective. And I value, or I should say, I took the net present value of those cash flows, discounting it by 8%. I get a net present value of $2.5 trillion. I add cash and take away debt. So I get to 2.5 trillion. The market cap of the company is just a little bit above that by 2%. So if I look at the value of Amazon, when I calculate it based on the future free cash flows, it's 2% lower than its current stock price. So stock price is a little high, tiny bit. The earnings per share tells me a different story. It actually shows a 22% discount on the stock because I do believe they deserve a 36 PE and they are going to grow those earnings nicely by 15%. I blend the two and I take more weight in the free cash flow method. When I do that, I get a combined 8% discount. Analysts were at 9.5 or so percent discount. I'm at 8, so I guess I'm consensus with analysts. Amazon is offering an 8% discount. Now, Amazon is a very valuable, desirable business with a very strong moat. Their network power is incredible. Nobody even comes close on the scale of e-commerce. They pretty much are a behavior pattern for most consumers. You're thinking of a new product, you search on Amazon to get a good price or availability. On the cloud side, they're dominant. Number one, nobody's bigger than they are in the cloud infrastructure business. So it being a very desirable business, it's a stock that I would buy at fair price, and I would definitely buy it at an 8% discount. Alibaba is a $326 billion market cap company. Its revenue is $139 billion. Alibaba predominantly operates out of Asia, serving China. But they also serve Japan, Korea, and other parts of Asia, as well as the Middle East. And they even sell into the United States, although most of their revenues come from China. It's a business that was built, I think, with the inspiration of Amazon. They have really strong partnerships with their suppliers. They don't really carry the inventory. They don't own the inventory that's being sold on Alibaba. Their partners own it and sell it on the Alibaba e-commerce platform. In addition to that, they have a cloud infrastructure business that really impressed investors at the last earnings call by showing that they're really growing that business by 26%. And also, other countries are developing on Alibaba's cloud, which is really interesting to see them really take some big workloads away from the big three hyperscalers in the US. The business has a PE ratio of 17 for the current year, almost 18 for the next year. That looks fairly low compared to Amazon. It's the discount you get on Chinese stocks, in my opinion. It's a strong buy with a 14% discount, and this stock has flourished in 2025. This was one of Charlie Munger's big bets. And once again, Mr. Munger would have been right. He died at 99 a year or so ago, and this was one of the stocks that surprised him as to why it didn't rise in prior years. But if he's looking down from above now, he's probably saying to himself, yep, I was right on Alibaba. Looking at their growth, the year-over-year growth doesn't look all that impressive. But again, their growth in the data center, the most strategic part of Alibaba, was very, very good. They also announced that they want to develop a chip for the AI workloads in their data center. That really energized the market, and Alibaba shares really rallied after their earnings. Like I did with Amazon, I completed a valuation on Alibaba, and I get to a 26% discount. This stock provides a discount whether I value it using cash flows or their earnings per share. Overall, that's very compelling. Owning Alibaba is a very good bet that they're going to continue to grow in Asia and that part of the world. They're probably going to dominate. I don't think Amazon can reach across the Pacific Ocean and compete with Alibaba like they can compete here in the US against anybody. I think Alibaba has advantages in Asia, and that region is going to continue to grow real fast, much faster than the US. So Alibaba at a 26% discount is a compelling investing idea for me. Mercado Libre is an e-commerce company in Latin America, and they've done a great job of growing their business down in Latin America. I really believe that the companies I've covered, Amazon, Alibaba, Mercado Libre, they each in their own right have a cultural advantage in their markets. Mercado Libre understanding the Latin American economy and the consumer better can really serve that consumer like better than Amazon or Alibaba or others. That is one of the advantages it has. Market cap for Mercado Libre is 119 billion, revenues are 24 billion. It has a high PE, and the forward PE is going to be 43. It does have good growth. It's a strong buy with an 18% discount. Year to date, the stock has performed well, although it's had kind of a flat last 4 months. The growth of Mercado Libre is much higher than both Amazon and Alibaba, but this organization is smaller by a substantial amount, especially compared to Amazon. So this growth is excellent, but the scale is really different than the two other players. So this looks really good. Let me show you the valuation. Mercado Libre offers a 26% discount when we compare the value of the company based on cash flows and based on earnings per share. We get a 26% discount. And that's with a higher discount rate since it's outside my home country down in Latin America. So that's a compelling discount on Mercado Libre. Investing around the world is a good idea for investors to diversify. Most of my stocks are in the US. That's great. But I look for opportunities to intelligently invest in other parts of the world where their economies might be growing faster than in the US. Mercado Libre certainly fits that bill. Prosus is a Dutch company doing e-commerce, internet retail. They're a $117 billion market cap company, revenues of 5.7, and these figures are in euros. The P/E ratio looks nice and low at 11, forward PE of 14. The stock has performed really well over the 1 year and the year to date. This company has very good growth rate of 12.86%, not quite as good as Mercado Libre, but a very good growth rate. When I value Prosus, I get a 20% discount available on this stock. And they've done really well for the year to date and over the 1 year. But I'm not going to penalize them for being successful and for investors wanting to be an investment or investor in Prosus, which is why I am buying into Prosus. Every stock I've shared with you to this point, I'm an investor in. And I started investing in Prosus because I think it's very compelling. To be invested in Europe with an e-commerce company like Prosus is a great opportunity. InPost is a company you may have never heard of. They predominantly are in Poland and other countries in Europe, and they provide these lockers that people can pick up a package that's been delivered to them by somebody, Prosus, Alibaba, Amazon, delivered to a consumer. They could safely go get their package. Their growth is really exciting, and I'd like to show you their fundamentals. Every stock I've showed you to this point has been going up year to date. And this stock here is down year to date. What's going on? Is this a problem? And the answer is it's not a problem. It might be an opportunity. The market cap is $6.9 billion in USD, revenue of $3.42 billion. Their PE ratio this year is 25, and then it drops down to 14 next year. The company has very good growth of 26%. This is in the Polish currency. Converted to US dollars, you would multiply this times 0.28. So we're dealing with about a $4 billion revenue company growing at 26%. Looks really impressive that they're growing in a very fertile market of e-commerce. InPost has a 52% discount available to investors. That's a very big discount. I think the sell off in the stock has a lot to do with the discount that's available. As I look at a business that's growing in a region that's doing quite well, as I research Poland, Poland's been doing quite well. Their stock market's doing great. So is Germany's and other countries in Europe. So this is an opportunity for me to jump into the European e-commerce market, and I gladly did so. I actually bought shares in InPost today. Sea Limited is a company headquartered in Singapore, servicing the Asian market and doing just fantastic. It's a $113 billion market cap company with almost $20 billion in revenue. Their PE is really high, 98. Forward P, 38.9. Analysts think it's priced 9.62% too high, but it is a buy. The reason why those fundamentals are so high is the stock is just flourishing. Year to date, it's up 81%. Over the 1 year, up 149%. Just on a tear. The growth is there in the business. It's a close to $20 billion business growing at 34%. So they're really putting up terrific numbers on the top line growth. They're profitable, free cash flowing, great company. When I value Sea Limited, it comes up with a 41% discount on the stock, mainly because the cash flows are just growing at a very good rate. It cash flows really well. And even earnings per share provide a discount. But combined, 41% discount is very compelling on a company that is growing very fast. So most definitely, this is a buy in my book, and I own Sea Limited stock. eBay was one of the original e-commerce companies a long time ago, and they've had a very good 2025 with the stock going up 49%. But it's also had a pretty tough couple of years when the stock was sold off for a long time. Overall, eBay is a $42 billion market cap company with $10.47 billion of revenue, P ratio of 20, and forward P of 16. Analysts believe it's a hold with a 13% premium on eBay. What's interesting is the stock has risen during a time of very slow growth. This is very slow growth. Their profits have expanded, but in this particular industry, it's really important to keep growing. If you're not growing, that means your competition is taking over market share. Your customer is going to other websites and buying product. So the lack of growth is a concern with eBay. When I value eBay, I get a 13% premium that's being priced into the stock. And I'm not too far away from where analysts were at 10% premium that they believe the stock is priced at. And overall, I don't like that eBay lacks momentum. They're not growing. While all the other companies that cover to this point, you see their growth. You see they're taking on bigger and bigger shares of a marketplace, while eBay is just pretty much idle. I don't like that strategically, and I don't like that they're being priced too high. This is absolutely a sell and an undesirable stock in my book. Carvana sells cars over the internet. It retails automobiles very successfully. My hat's off. How they pulled it off is incredible. What they also pulled off was a comeback for the ages. This stock was kind of left for dead after the used car market collapsed. These guys had a liquidity problem. They had a pretty good risk of defaulting on loans, being stuck with cars and not enough cash. They made it back. Investors that believed in them, boy, did they flourish, taking their stock price from $5 up to $375. Congratulations if you own Carvana. But it's not a matter of where they've been, it's where they're going, where their stock is going to go. This stock is about an $82 billion market cap with $16 billion in revenue. PE is really high, forward PE is high. Analysts think they're fairly priced in their buy. The things I don't like about Carvana is very small margins, very little cash flow generated by the business. And yes, they're growing, but they're growing in a marketplace that to me is not very desirable. The automobile business is incredibly competitive, and these guys are right in the thick of it. Their stock price is also very high. When I value Carvana, I show that I have a stock that is priced 66% too high. They don't produce a lot of free cash flow. They don't produce a lot of profits. It's an incredible story to see them recover from their business almost being bankrupt and their stock price being at $5 a share up to where it's at today. Incredible. But I don't buy stories. I buy companies based on what they're going to do for the next couple of years. In the case of Carvana, I just think this stock is going to settle down and really investors are going to take a pretty good haircut on their investment. Maple Bear is giving people the ability to order their groceries on an e-commerce platform. And they've been very successful. They were helped out by COVID when we had all these shutdowns and people were afraid to go out and catch the virus. Now they're continuing to grow and their stock is doing okay this year, year to date. It's probably lagging the S&P. Over the 1 year, it's doing quite well, 34%. It's a $12 billion market cap company with $3.55 billion of revenue. PE is 26, forward PE of 22. Analysts think it's a buy and it's discounted. There's been a story that Amazon's going to go into their space. And I don't doubt that Amazon wants to go into the grocery business because they have Whole Foods, they have Amazon Fresh, and so forth. But I think specialization, especially around grocery, is really important. Grocery with perishables and so forth. I don't think a big organization like Amazon is going to do as well as Maple Bear. When we look at their revenue growth, they are growing nicely, 10.5%, and they're very, very profitable and generate cash. The Maple Bear Instacart stock is very discounted. I think the story that Amazon's going to compete against them has really lowered the stock price. And I don't think that story is all fact. I think it's more emotion and fear than it is fundamentally a story that I'm going to pay attention to. The company has been growing really well, generating great free cash flows, and the cash forecast, the net present value of all those cash flows is 58% more valuable than the current stock price. Even on earnings per share, it provides a discount. Overall, a 52% discount is an opportunity to buy the Maple Bear stock. I'm currently a stockholder in Instacart. Wayfair is having a very good 2025 from a stock price perspective. The stock is up 94%. And this company is an $11 billion market cap company with revenues of $12 billion. The stock is priced 22% too high, according to analysts that still have a buy rating on Wayfair. They're losing money this year, but next year their PE is supposed to be 46. When I look at Wayfair's growth, there is none. It's been really losing market share over the last couple of years. And these are years when they should have been growing. And their most recent trailing 12 months showed just a tiny bit of growth. That's a surprise to see a stock go up so much while the revenue is really down. I think a part of the story that tells me why the stock has risen so much is that it fell from a very high stock price down to a very low stock price, and it's now recovering from a very strong sell-off. I took Wayfair's fundamentals, put them in my valuation model, and I come up with a value that's 46% lower than their current stock price. So the stock price is 46% too high on Wayfair. I think the run up on the stock price probably over exceeded its intrinsic value a while ago. And this company doesn't have the profitability and cash flow to really match up to its high stock price now. Therefore, Wayfair would be an absolute sell. I would stay away from this stock for my portfolio. So, which stock is the best investment I can make today, and which one is the worst investment I can make today? Let's go over that with best to worst. So, to the far left are the best stocks for my capital, starting with InPost. I think the discount available on InPost is compelling. I think their business is doing really well. The stock's really sold off. How and when I buy a stock is really important. I really think they have a very good business and the discount available is a big opportunity. Sea Limited has been flourishing and I don't think they're going to stop anytime soon. They have a good discount available on the stock price and I am buying up shares. That's the number 2 best opportunity. Number 3 is Instacart. Again, when and how I buy the stock is really important. And Instacart, the stock price has been sold off and provides a really nice opportunity. Now, Amazon, Alibaba, Mercado Libre, Prosus, all are very good investing ideas for me. I am a stockholder in Amazon and continue to add shares just because they're so important overall to the economy within technology with their cloud business. I want more shares. I also want more shares of Alibaba. Tremendous company, really having a big part of the future of e-commerce in Asia in Alibaba as well as their cloud business looks great. Mercado Libre. I own Mercado Libre and add shares because they are doing the best down in Latin America for e-commerce. They also have a lot of innovations around payment processing and financial services. And Prosus over in the Netherlands, servicing Europe as well as other parts of the world. So these are just fantastic opportunities to be in an industry that has a bright future. But not all companies are great in this industry. I think that eBay is really seeing their heyday leave them, I don't know, 15 years ago. It's interesting that the stock has risen, but it's because it was sold off so much. And I just don't see their business is going to do all that great. I think capital, if I deployed it to eBay, it would probably just sit idle or go down in price, which would be unfortunate. Carvana. I am staying away from Carvana. I am a fan of the company. I think it's great that they came back, but their stock price is just way too high in a volatile market that has very little margins and so much competition. And the worst stock that I could buy with my hard earned capital is Wayfair. It's really come back and the stock has risen quite a bit, but the business itself isn't growing, doesn't make a lot of money, doesn't create a lot of cash. And that business is likely going to be taken away, or they're going to have to heavily compete against the likes of Amazon and other very strong players that are really growing. So that's my review of the best to worst internet retail e-commerce companies. I hope you found it interesting. Thank you for watching my channel. It's been really fun and satisfying to have a channel for a couple of years. I've met a lot of great investors, and together we've really grown. And I wanted to offer you the opportunity to become a member of the channel. It'll give you more access to valuations, research, more access to more videos, the tools that I use, as well as being more connected with me as well as other members of this channel. There's 4 different levels. Take a look and see if one of the levels is something you'd be interested in. I think you'll benefit from being involved, and I hope to see you soon on one of the member calls or on Discord.